Hello ladies and gentlemen, welcome back. In this video we're going to look at reasons for valuations. But let me remind you the importance of this topic. Remember I said when we started, the choice of a valuation method depends on the reason why you are doing the valuation. So for instance, you want to value a business which is no longer going concern. Obviously, in such a situation, you cannot use the PE ratio because you cannot compare the business to its peers since the business is not going to keep on existing. Rather, in such a situation, you then have to use a valuation method like the asset-based valuation method because possibly you're going to sell all the assets of the business. However, if you are valuing a business which is still a going concern, possibly you will look at the free cash flow method or the PE method because the business will continue operating. So, reasons for investment will govern how and which method you can actually use when you are valuing the business. Now, there's one important thing that you should know when we're talking about business valuation. In all the cases, we would have arrived at a junction. It's either you have to buy, to sell, or to keep on holding. In all the cases, in all the situations, this is the decision that you are always faced with when you need evaluation, whether to buy more shares, to sell some shares, or to keep on holding. And for you to move from this junction, for you to move from this predicament, you need to know what you're going to gain and what you're going to lose so that you make the best decision. Now, the first reason for valuation is mergers and takeovers. So, when companies amalgamate, or when two companies join together to form a new company, you need to understand the value of the other company that you're joining with so that you know how much to pay for it or how much to receive from the company for the merger. In cases of takeover, you might be the company that is being taken over and you want to know how much you should ask from those who want to take you over. And if you are the company which is taking over, you need to know what to offer, how much you can offer, and such situations can only be answered by business valuation. So, in cases of mergers and takeovers, you need to understand how much you're going to lose, how much you're going to gain, how much you can offer, or how much you can accept as an offer. And that can only be answered by business valuation. And the next situation will be investment decision. So a decision can be made on whether to keep holding a share or dispose it based on the difference between its market value and intrinsic value. The intrinsic value is established using valuation methods. You realize that the market value is always prone to manipulation due to its reliance on supply and demand. And investor fears can also affect the market price of a share. However, the intrinsic value will always remain the same. So you might also need to establish the intrinsic value of the company using the valuation methods that we are going to dig deep in this course. Say you are in a partnership and the partnership is being dissolved. You might actually want to know how much you should receive as compensation, or if you want to introduce a new partner, you might actually want to know how much you can ask from the partner so that he can join the partnership. So dissolution of a partnership can be a situation which leads to business valuation. So you need a business valuer in all these situations. Right. Another reason is convertible debentures and preference shares. Now, a time will come when the preference shares that you would have issued with an option to the holder to convert them into shares. And the person or the investors would now want to convert those preferred shares into shares. You might actually want to know how much in shares you are going to give them, and to what extent will this reduce the earnings per share and stuff like that. So convertible debentures and preferred shares might actually call for an asset valuation, so that you know how many of these shares you are going to issue. In the case of nationalization, the government might want to know how much they can compensate you for taking over your company. So, in such situations, again, you might need a business valuer to help you, or you can do it yourself if you know how to do it, which we hope that at the end of this course, we'll all be on the same page regarding valuation. In buy or sell agreements, if your business has more than one shareholder, a valuation is required to establish fair market value of the business to determine equity distribution when specified trigger events occur. Also, the valuation enables life insurance requirements funding mechanisms for your buy and sell agreement to be more accurately determined and updated as required. Now, estate and gift tax. Estate tax returns require an independent valuation as of the date of death. Gifting of closely business interests require an independent valuation of business at the time of ownership transition. Right. So in case of estate or gift tax, there is a necessity to value the business so that we know how much tax can be paid from that. That's what we're saying there. In the case of the death of a shareholder, we want to see again the value that is going to transfer and the tax that can emanate from that. So again, in employee stock ownership plan, we want to know how much in value are you giving to these employees, so that we know how much tax to charge to those who are receiving the shares, as well as the company which is paying, which is giving the shares. Right. So evaluation is required for the company to properly report related compensation expense, and for the recipients to accurately report income. So if you are the company, that employee stock ownership plan can be recorded as an expense, and then for the recipient of the income, those are the employees, that will be income, and we need to record it accordingly so that each person gets to be taxed exactly the actual amount they should be taxed. Right. Now, in litigation support, you might actually need to value a business. Business valuation is often needed to establish economic damages in commercial litigation proceedings or to determine equitable distribution in shareholder disputes. Right. So if there's litigation court cases and stuff like that, you might actually need to know the value of the business so that we can ascertain the type of compensation that can come from there. For insurance purposes, increasingly insurance companies require appraisals be done on equipment or business that are insured. So insurance companies need to know how much exactly are they protecting, so that they can make their plans accordingly. Right, divorce and estate settlement. So when all things are not as they were meant to be in marriage, and you've reached a dead end and now it's divorce time, you might need to value your business, and so that you know how much you can compensate each other. A business valuation will either be court appointed or voluntarily engaged to facilitate an equitable distribution or settlement in case of a divorce. Right. So let's meet in future videos as we continue to explore business valuation. Thank you.